Hello, this is Steve Balch from Certa Financial Planning. I'm the Director of Wealth Management and Financial Planning here at Certa. I'm here to give you the monthly market update for October 2023. Here are the 5 things we'd like you to know. Certa's current positioning. September strikes back. A top-heavy market. Yields keep moving on up. Higher for longer seems to be the new standard, and October volatility could lead to opportunity. Our belief is that since 2021, the market's been in a trendless environment, chopping back and forth, determining if it wants to go into an uptrend or a downtrend. Because of that, our stance has been neutral across the board in all our strategies. Here are some of the factors we look at to determine that stance. The market trend has moved slightly from a weak positive to a neutral stance with a market pullback. The Fed policy with their tightening and rate hikes has been a weak negative for the markets. The government continues to spend and continues to run deficits, and that is a slight positive for the markets. Now, that could be ending with recent issues going on in the government, but for now, we continue to see this as a net positive. Economically speaking, jobs continue to be solid, although we have seen a contraction in job openings. GDP from the Fed in Atlanta, the reading is giving us a positive for Q3, and the consumer continues to spend. So for the short term, our economic outlook continues to be positive. Long term, the risk of recession continues to remain high. How deep and how bad the recession will be depends on many factors, but for now, our economic outlook for the long term continues to be slightly negative. Lastly, valuations in the market have come down, but they're still above historical averages. We'd like to see valuations come down a little bit more to create a more affordable buying opportunity for the long term. Now, September strikes again. Historically speaking, September has been the worst performing month, with the average return of negative 1.2%. That played out again this September as asset classes across the board saw negative returns. The only positive returns were the dollar and crude oil up about 7.7%, which created a positive return for the commodity bucket as well. The S&P 500 lost about 5%. Year to date, it's been a mixed bag of performance. We've seen stocks do fairly well. Equities are slightly positive, but bonds have been negative across the board for most asset classes. The best performing asset class has been the S&P 500. However, that S&P 500 is a little bit misleading and has been a bifurcated return. The top 7 companies in the S&P 500, the Magnificent Seven as they've been nicknamed, are led by the AI boom and are all tech companies that you see all the time on the news. Those companies now equate for 28% of the S&P 500 market cap. So if we look at the year-to-date performance through September, the S&P was up 11%, just over 11%, 11.3%. The Magnificent Seven companies were up 81%. If we equal weighted all the S&P 500 companies, the return would be negative 0.2%. What does this mean? That means the remaining 493 companies have been lagging and have not been performing as well. The Dow Jones is barely positive, actually just went negative for the year, and dividends have struggled as well. If this is going to be a long-term solid bull market run, we need the breadth and performance of the remaining 493 positions to pick up. Now, yields keep moving on up. This is part of the reason we've seen such a volatile sell-off and a little bit of some volatility pickup in the markets across the board for the last couple of weeks. The Fed met in September and discussed their outlook for the rest of the year and their take on inflation. Inflation's come down, but it is sticky and still causing an issue. So the Fed believes that there's a chance that they're going to raise rates again in November, 25 basis points. However, the big takeaway was the market believes the Fed was going to start cutting rates at the end of this year or into the beginning of next year. The Fed stated that they believe they're going to keep rates longer until at least the second half, potentially the end of 2024 before their first cut. The market, realizing that higher for longer is a new trend, adjusted by moving rates upwards. The 10-year Treasury moved to yields that we haven't seen in over 16 years. Now, this is going to cycle through the economy and definitely cause a slowdown of some sort. However, it's not all a net negative, as we've seen short-term yields continue to move upwards. If you're a conservative investor or looking to park money in protective assets and earn an attractive yield, short-term bonds, short-term treasuries, and short-term CDs are now paying over 5% for 3 years or less. We don't know where this is going to peak. We don't know when the rate hikes are going to stop. We don't know where terminal rate is going to be. However, at over 5% on short-term rates, we do find these attractive and think that is something that you can do to put your money in, be in a good spot for the next handful of years. Lastly, October volatility could lead to opportunity. Historically speaking, October has been the most volatile month with the most 1% moves out of any month historically we've seen. However, It's also the month when most 5% pullbacks have ended. We're also in starting quarter four, and quarter four historically has been the best performing asset, or excuse me, quarter four has been the best performance for the markets going historically back to 1945. So what does this all mean here? Our belief is that everything that's been going on has been normal and in normal ranges and in seasonality. The pullbacks have been normal pullbacks between 5 to 10%. And there's a high probability that we're going into a time period when seasonality shifts and we enter a period when the market historically has done its best. Now, things may change. Maybe rates continue to move upwards and cause a big issue, or another shock happens that we're not aware of right now. But for now, we continue to remain neutral. We believe the markets are getting close to oversold stances as the fear index is rising to levels we haven't seen in a while. So there's a high probability in our belief that the pullback correction that we're seeing right now does end in October and seasonality plays out, and there's a higher probability of the market finishing stronger to end the year. We'll continue to watch this trend and things may change, but for now, we continue to remain in neutral to slight positive for the rest of the year. We appreciate you watching this presentation. If any questions arise, please reach out to us. Thank you and have a wonderful day.